In professional trading, the primary focus is on protecting capital. Capital preservation takes precedence over the pursuit of immediate profits. Profitability is viewed as a consequence of sound risk management strategies. Effective risk management is crucial for long-term success in trading. Prioritizing capital protection ensures sustainability and growth in trading activities. Losses are an unavoidable aspect of trading in financial markets. Adopting a risk-first strategy is crucial for managing potential losses. This approach helps traders prepare for adverse scenarios effectively. Proper risk management prevents significant capital depletion during losses. Trading should be viewed as a long-term strategy rather than a get-rich-quick scheme. Consistent losses, when controlled, are indicative of disciplined risk management. Effective risk management is crucial for long-term success in trading. Discipline in adhering to a trading plan is essential for managing potential losses. Emotional control is vital to prevent impulsive decisions driven by fear or greed. Successful trading requires a strategic mindset focused on consistent, calculated actions. Position sizing is a critical tool for effective risk management. It directly dictates the amount of capital at risk in any single trade. Proper position sizing limits potential losses from adverse market movements. It also helps to protect overall trading capital. Therefore, position sizing is essential for sustainable trading and investment strategies. The 1 to 2% rule is a risk management guideline for trading. It limits the amount of capital risked on a single trade. According to this rule, no more than 1 to 2% of total trading capital should be at risk per trade. This helps to protect against significant losses from any single unsuccessful trade. Effective risk management is crucial for both novice and experienced traders. A 1% risk strategy limits potential losses on each trade. With a $10,000 account, a 1% risk translates to $100 per trade. This limit helps preserve capital and manage emotional decision-making. Adhering to a predetermined risk percentage is a cornerstone of disciplined trading. Consistent risk management is key to long-term success in trading. Limiting risk to 1% per trade is a strategy for preserving capital. This approach minimizes the impact of consecutive losing trades. Small losses prevent significant account depletion. Capital preservation ensures funds are available for future opportunities. Consistent risk management is crucial for long-term success. A 1% risk limit helps maintain a stable trading account. A stop-loss order is a tool used to limit potential losses in trading. It is crucial to set a stop-loss order before initiating a trade. This order automatically closes a position when the price reaches a specified level. Setting a stop-loss helps protect capital by preventing excessive losses. It provides a predetermined exit point, reducing emotional decision-making. Effective stop-loss placement is crucial for managing risk in trading. Stop-loss orders should align with established market structure. Key structural elements include support and resistance levels. Avoid setting stop-loss orders based on arbitrary monetary values. Entry point calculation is crucial in risk management. The calculation is based on the stop-loss distance. It also factors in the maximum acceptable risk amount. These two parameters are essential for determining the optimal entry point. Balancing risk and potential reward is the goal of this calculation. Position sizing is a fundamental risk management technique in trading. It determines the appropriate size of a trade based on risk tolerance. The formula for position size is account risk in dollar, distance to stop in points. Account risk represents the maximum dollar amount you're willing to lose on the trade. Distance to stop refers to the number of points between your entry and stop-loss order. Using this formula helps control risk and protect trading capital. The risk-to-reward ratio, RR, is a metric used in trading and investment. It quantifies the potential profit relative to the potential loss of a trade. The R helps investors assess the attractiveness of a potential investment. A lower R generally indicates a more favorable trade. It provides a structured way to compare potential gains against potential downsides. The risk-reward ratio, RR, is a fundamental concept in trading and investment. It quantifies the potential profit relative to the potential loss of a trade. The goal is to achieve a minimum R of 1 to 1.5, meaning the potential profit is at least 1.5 times the potential loss. A desirable target for trade efficiency is an R of 1 to 3 or higher. This indicates that the potential profit is 3 times greater than the potential risk. Higher R ratios generally suggest more favorable trading opportunities. A 1 to 3 risk-reward R ratio means risking 1 unit of capital to potentially gain 3 units. In this example, $100 is risked with the aim of achieving a $300 profit. This ratio demonstrates the potential for profitability, even with a less than stellar win rate. The high reward relative to the risk allows for overall profitability despite some losses. Effective risk management is crucial when employing such strategies. Traders must carefully assess the probability of success and potential losses. A 40% win rate means that 40% of trades are profitable. A 1 to 3 risk-reward R ratio implies that the potential profit is 3 times the potential loss. Even with a relatively low win rate, profitability is possible due to the magnitude of the reward. Higher profit potential per winning trade compensates for more frequent losses. Maintaining a consistent stop-loss level is crucial for risk management. Avoid adjusting the stop-loss to artificially improve the risk-reward ratio. R. Widening the stop-loss increases potential losses beyond the initially defined risk. Such adjustments undermine the integrity of the risk management strategy. Sticking to the original stop-loss ensures consistent risk control. Disciplined stop-loss management protects capital and prevents excessive losses. Portfolio diversification is a risk management strategy. It involves spreading investments across various asset classes. The goal is to reduce exposure to any single asset or correlated assets. Diversification minimizes the impact of any one investment's performance on the overall portfolio. This strategy helps protect against significant losses from market volatility or specific asset downturns. Simultaneous positions in highly correlated assets increase potential losses. EUR, USD and GBP, USD are examples of currency pairs with high correlation. Taking positions in both EUR, USD, and GBP, USD effectively doubles down on a similar directional bet. This amplifies risk because both assets are likely to move in the same direction. Macro events can significantly impact all market positions. Major news announcements are a key source of macro risk. These announcements can trigger market-wide volatility. Traders should be aware of scheduled announcements and potential impacts. Monitoring macro events is crucial for risk management. Loss limits are implemented to prevent significant account depletion. These limits can be set on a daily or weekly basis. The purpose is to avoid catastrophic financial losses. Trading activity should cease immediately upon reaching the predefined loss limit. This practice helps in maintaining capital and managing risk effectively. The risk-first trading workflow begins with chart analysis. The purpose of chart analysis is to identify potential trade setups. Identifying setups is the initial step in the trading process. This approach prioritizes risk assessment from the outset. Identifying key support levels helps determine where buying interest is likely to emerge. Resistance levels indicate price points where selling pressure may prevent further upward movement. Support and resistance levels are crucial for setting stop-loss orders to manage risk. These levels also assist in establishing profit targets by anticipating potential price reversals. The placement of a stop-loss order is a critical trading decision. A stop-loss order should be placed at a level where the original trade setup is invalidated. Invalidation implies the reasons for initiating the trade no longer hold true. This placement helps to limit potential losses if the trade moves against the trader. Proper placement is essential for effective risk management. It ensures that losses are cut when the initial trading thesis is proven incorrect. Profit targets should be established using logical, technical levels. These levels should be identified through technical analysis. The selection of these levels must ensure a favorable risk-to-reward ratio. A beneficial ratio weighs possible profits against possible losses. This approach aims to optimize profitability while managing risk effectively. After initiating a trade, adhere to the predefined plan without premature intervention. Allow the trade to progress naturally. Following the initial strategy, only adjust the stop-loss order to the break-even point when the price moves favorably. This approach secures the initial capital once the trade demonstrates profitability.